If you are giving to charity the old-fashioned way, writing checks in December hoping for a deduction, you could be missing out on thousands in tax savings. There is a smarter way. It's called a donor-advised fund. It's what many wealthy families use to simplify their giving, reduce taxes, and make a bigger impact without rushing big decisions. Today, I'm going to show you how donor-advised funds, DAFs for short, let you lock in big tax deductions when your income is high, without forcing you to rush charitable decisions. Imagine a charitable holding tank. You make an irrevocable contribution to a public charity, called a donor-advised fund, and immediately get a tax deduction. Now, when I say irrevocable, I mean you can't get the money back for personal use. It's committed to charity. But here's the key. You advise on where and when the money gets distributed to operating charities. Meanwhile, your contribution can grow tax-free, and you can grant it to any qualified nonprofit whenever it makes sense for you. Picture two buckets. Bucket 1, you get your deduction now when it benefits your taxes most. Bucket 2, you send out the actual gifts later when you've had time to research and decide. That separation is the game changer. Most people combine these decisions and end up making rushed choices in December just to get a deduction. With a DAF, you can optimize both decisions independently. The money sits in your donor-advised fund, growing tax-free, while you take your time figuring out which causes matter most to you and your family. You might grant it out immediately, or you might let it grow for years while you develop your charitable strategy. Let's look at the numbers, because they are pretty staggering. In 2023 alone, DAFs gave out $54.8 billion. That's about 10% of all US charitable giving. Total assets in DAFs, over $250 billion, even in a down market. And yet, half of high-income families still haven't used one. Which means if you are using a DAF strategically, you're not just ahead of the curve, you're ahead on your taxes too. This growth isn't happening by accident. People are discovering that DAFs solve real problems. Timing mismatches between when you want tax deductions and when you want to make charitable decisions. The complexity of donating appreciated assets directly to charities, and the administrative burden of tracking multiple charitable gifts for tax purposes. Think of a DAF like a superhero utility belt. Here are 6 things it can do that most people miss. First, timing arbitrage. Get the deduction now during a high-income year. Give later when you've had time to think it through. Second, donate almost anything. Cash, obviously, but also stocks, crypto, real estate, even private business interests. Most individual charities can't handle complex assets, but DAF sponsors can. Third, higher adjusted gross income limits. You can deduct up to 60% of your adjusted gross income for cash donations and 30% for appreciated assets. That's significantly higher than private foundations. Fourth, tax-free growth. Investments inside the DAF grow tax-free while you are deciding where to grant the money. Fifth, anonymity. Want to give without your name attached? The DAF can make grants in its own name, keeping your privacy intact. And sixth, estate plan glue. You can name successor advisors, typically your children, to continue your charitable legacy with clear guidance on your values and priorities. Let me show you exactly how this works with specific numbers. One couple I work with gave faithfully to their church every year, $15,000. But they were frustrated. In their 30-plus tax bracket, they expected to see a tax break. And it didn't. Their standard deduction kept canceling out the benefit. We showed them how bunching several years of donations into one donor-advised fund contribution could unlock the full deduction. That one move turned their generosity into a $15,000 tax savings. Here's the logic behind it. Let's say you're a married couple who normally gives $20,000 a year to charity, maybe $12,000 to your church, and $8,000 split between your university and local food bank. You have other deductions like state taxes and mortgage interest that bring your total itemized deductions to about $35,000. That's only $5,000 above the $30,000 standard deduction in 2025. So you're not getting much extra tax benefit. Here's the bunching strategy. Instead of giving $20,000 per year for 5 years, you put all $100,000 into a DAF in one high-income year. Maybe when you have a bonus, sell some stock, or take a larger required minimum distribution. Now your itemized deductions jump to $115,000, dramatically above the standard deduction. In years 2 through 5, you don't make additional contributions. So you just take the standard deduction each year. The result? Without bunching, your total deductions over 5 years would be around $175,000. With bunching, they jump to $235,000, a $60,000 increase in deductions. If you're in a 32% tax bracket, that's roughly $19,000 in tax savings, just from changing when you give, not how much. And your DAF still grants out the full $100,000 to your church, university, and food bank over 5 years, exactly like you planned, but with a dramatically smarter tax outcome. Here's an even more powerful strategy, especially if you are planning to sell appreciated property, a business, or significant stock positions. Imagine you are about to sell a rental property or business worth $5 million, and you've always planned to set aside $1 million for charitable giving. Most people sell first, pay capital gains taxes, then donate cash. That's the expensive way. Here's the smart way. Donate $1 million in equity directly to your DAF before the sale. You avoid paying capital gains on that donated portion. That saves you roughly $238,000 in capital gains taxes, assuming a 23.8 rate, including the net investment income tax. You still get the full fair market value deduction of $1 million, and the DAF sells the equity tax-free, so the full $1 million is available for your charitable goals. Compare that to selling first, paying the tax, and donating cash. You lose a huge chunk to the IRS for no reason. Net difference, over $238,000 in your favor, just by changing the order of operations. This works with any highly appreciated asset, real estate you've owned for decades, stock that's grown significantly, even cryptocurrency that's appreciated substantially. Now, if you're looking at a situation like this, maybe you are planning to sell property, expecting a large bonus, or facing a big required minimum distribution year, we should probably run the numbers specifically for your situation. I've put together a free charitable strategy session where we can model exactly how a DAF might work in your particular circumstances. There is a link below to grab a 45-minute session, and we can see if this makes sense for your goals. Now you might be thinking, this sounds like a private foundation, what's the difference? Here's a quick comparison. Setup time. DAF takes 20 minutes online. Private foundations take 6 to 12 months with legal work. Cost. DAFs typically cost $0 to $500 per year. Private foundations run $20,000 or more annually in legal, accounting, and filing fees. Adjusted gross income limits. DAFs give you 60% for cash and 30% for assets. Private foundations limit you to 30 and 20%. Disclosure. DAF grants can be anonymous. Private foundations require public 990 filings showing every grant. Unless you are running a multi-million-dollar foundation with staff and board meetings, a DAF is usually the smarter choice. In fact, some wealthy families are now closing their foundations entirely, moving assets to DAFs for greater benefits and far less hassle. Let's be completely honest. DAFs aren't perfect for every situation. First, you can't make qualified charitable distributions from your IRA into a DAF. QCDs have to go directly to operating charities. Second, when you contribute to a DAF, you give up legal control. The sponsor technically owns the fund, even though you retain advisory privileges. In practice, reputable sponsors almost never override donor recommendations, but legally it's their decision. Third, fees and investment options vary wildly by provider. Some charge high fees and limit your investment options, while others offer more flexibility. Fourth, there's been some public criticism about donors warehousing wealth in DAFs without ever granting it out. If you are setting up a DAF, make sure you actually intend to use it for charitable giving, not just as a tax shelter. So if you have zero interest in charitable giving and only want to maximize money in your pocket, a DAF isn't for you. But if you're already charitably inclined and want to optimize both your taxes and your giving impact, the benefits are hard to beat. Not all DAF sponsors are created equal. Here's what to look for. Minimums. Some start at $0. Others require $25,000 or more to get started. Asset acceptance. If you want to donate real estate, business interests, or cryptocurrency, make sure they can handle complex assets. Advisor access. Can your financial advisor manage the investments, or are you locked into the sponsor's limited options? Grant flexibility. Can you make international grants if that matters to you? These vary significantly and will impact your long-term giving capacity. Some sponsors offer what's called open architecture. Your advisor can manage the assets at any custodian while giving you complete flexibility on grants. Others require you to use their platform and investment options. The key takeaway is this. If you're already charitably inclined and have significant income or appreciated assets, Donor advised funds are probably the most tax-efficient way to give. They separate the tax decision from the charitable decision, letting you optimize both instead of rushing to make the choices by December 31st. The key is understanding that this isn't about avoiding charitable giving. It's about being smarter with the timing and maximizing the impact of dollars you were already planning to give away. For families with $2 million or more in assets who care about both tax efficiency and charitable impact, DAFs are often a game changer. The question isn't whether you should consider one, it's whether you can afford not to. Because in the end, giving isn't just about writing checks, it's about making your money matter. Now, DAFs are fantastic if you are ready to give. But how do you make your giving even more effective? In this video, I'll show you how to maximize your impact with tax-savvy charitable giving using strategies that go beyond the DAF. Don't miss it.